Hi, it's Phyllis Rector. I was thinking when I was doing some of these videos, and particularly the one on spot factoring versus full factoring, I really didn't I pointed out how they work, but I didn't really point out situations where full factoring really is the solution for a particular company, and in spot factoring where the situation for spot factoring would fit a particular company. So let me just give you some scenarios, and hopefully you'll keep in mind what I said about full factoring versus spot factoring. So full factors, generally speaking, will advance anywhere between 80 to 90% of your eligible AR, and eligible means that they've qualified your customer for, yes, creditworthy. And second of all, that it's not over a certain, it's not too old. Generally speaking, they don't want to advance against anything that's older than 90 days, because the older anything is, the less likely it's going to be paid. So keeping that in mind, if you had $100,000 in receivables and it was all eligible, then you could get 80 to 90% of that in terms of sooner payment on it, because that is what we call the advance rate. So that's a particular situation where if you need that kind of money, and particularly if you feel that you're going to need it on a regular basis, that actually might be the time where you really should be considering full factoring. The other thing is that if you have a customer base that, say, is highly concentrated, and that means if you have more than 40, well, I should say more than, say you have 90% of your business with one customer. In fact, I talked to somebody today who had virtually 100% of his business with one customer. Spot factoring won't work in that situation, because spot factors, because doing it with recourse, they require that you have two customers and that they will only advance as much on one invoice as you have on your books that they did not advance against or did not purchase, that would be recourse if something were to go haywire with the invoice that they did purchase. So for spot factoring, the maximum that you can get out of your receivables in terms of speeding up your cash flow is going to be 55%. In construction, it's going to be a little bit less than 50%. So so first of all, if you need more money, full factoring is the best way to go. If you are highly concentrated with one customer, that may be the only route for you, but then keep in mind that this customer's got to be really good credit. But if you have a contract with the US government and you only have, and he's your only customer, the risk there is only the dispute risk, not the default risk. And so you'll basically, if you get into a dispute and it's on with a full factor, you'll just pay the daily fee while it gets resolved. But the issue is it will likely get resolved. So that's basically the situations where you need it for full factoring versus spot factoring. Spot factoring is really ideal for companies who have seasonal needs. Okay, so if you're getting ready and you need to bulk up on raw materials to make toys that you're going to deliver for Christmas, that might be something. Spot factoring is particularly if you're experiencing a growth spurt that you expect to level off. We see it in staffing companies where they just get a new contract and they need 6 weeks to 2 months worth of speed up of their cash flow till they get back to steady state level when they take on a big new client. Those are the situations where you really should be considering spot factoring. Spot factoring would be really ideal. And then, of course, as I say, in construction, very few factors will even do it, and spot factoring does tend to manage that risk of the flow of funds and the lien waivers and all that kind of stuff. So I hope that's kind of clarified it, and I hope you're enjoying this educational series. Talk to you soon. Bye.